Good evening. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms, and I'm back with another strategy session on the market at large and how we can use closed-end funds to improve our investing. So the disclaimers. This is an unedited video. You get all my mistakes. Who knows what you'll hear in the background as I film these in my house? Honestly, hopefully not much. Most people are asleep. I am not a financial advisor. I'm a financial strategist, really just a strategist in general. Strategy, logistics. I love this stuff. And I don't speak like the herd. I walk in limited company and sometimes I walk alone. So as we look back on last week, what changed? Well, at the end of the week, the fear and greed index is on the move, climbing higher into the greed territory. Consumer confidence is up despite being lied to in the last jobs report. Supposedly, we're going to see an accurate update at the end of this week. But I mean, seriously, guys, do you really trust the numbers? The jobs report is tinkered with and tweaked and averaged. I mean, you've got seasonal jobs for every uh, cultural holiday now. You've got, uh, honestly, just a lot of fluff and nonsense included in that jobs report. So they're always fluffing the numbers. It's just, do you really trust the numbers? Um, the Fed all but announced they're dropping rates. It kind of just depends on how much. A 1/4% rate drop would be huge, but you have some people speculating it'll be a 0.5%. And then reminders as we move into this new, I guess we'll still call it hopeful cycle, but as we approach this rate cut cycle, just like the 4% withdrawal method is trash, the stocks do better in the long run mentality is faulty advice. The same people that use that strategy are also the same group of people still hailing that 60/40 stocks to bonds strategy as the gold standard when it's more like a fool's gold standard. Those strategies leave a lot of money on the table while inflation devalues your money and eats your gains. Because, I mean, just case in point, the basic SPY ETF pays just 1.2. 1.2. That's woefully horrible compared to a closed-end fund that'll pay you 9% in dividends alone. I mean, we factor in real inflation, not the fluff inflation the Fed gives us. If you factor in real inflation close to 4%, that 1.2 annual gain means that you're still losing at least 2.8% every single year. And that's hidden inflation. Your stocks are going up, but your gains and your dividends, right? Your overall value is just getting destroyed. Why go through that when you can invest into a set of funds that blows by that 1.2% payout? So, I mean, if you're new to my videos, what investment would do that? But I mean, quite honestly, I talk closed-end funds. So closed-end funds give us access to great funds with better than 8% dividends and price gains, and they sell on discount. So we get low risk, improved upside as those discounts close, and then great access across all investing platforms. So why let the 1.2% kill your retirement when you can crush it with closed-end funds? In our Roth account, we have two accounts, both managed under the Webull umbrella. Uh, we have an individual account, we have a Roth account. The Roth account, our average dividend yield is just over 12. Yeah, 12%. That's 10 times higher than that 1.2 annual gain you're going to get in that S&P ball and chain. So the methodology we're using, closed-end funds, it's a closed system. There is a set number of shares. It's direct supply and demand, right? It's not like you pick your ETF, pick an S&P ETF, where if they ever sold out of shares, they could just poof, pick one out of thin air, hand you a sticky note with one share value, and it bears no impact upon the rest of the outstanding shares. Closed-end funds is supply and demand. When they're popular, and the demand is high and the shares are low, guess what? They go up, right? But that also means you can catch them on discount. So for whatever reason, they, one in particular, but for whatever reason, they hit a spot where people just aren't happy. They're not confident. It's just not in the fad, I guess you could say. You can kill on discounts. You can kill on discounts. So the strategy, got to see the big picture. I mean, most people focus on now. Fear and greed index is in greed. So you've got new money pouring into the market, elevating the price of everything. Is it the time to buy? Maybe, maybe not. Whatever you're buying is probably worth more than when you initially bought it, unless you're buying it now, and then it's for sure worth more than it was a month ago. But you have a ton of new money pouring into the market. If the Fed cuts rates, it's going to pump more money into the market and send everything higher. So if you're going to buy in greed, got to get a discount. Got to play the long game. So you see the picture now, right? But how do you think the market's going to be in 10 years, 20 years? Can you look beyond the next 6 months to say 36 months, 3 years, right? Regardless of who's in the White House, can you really look beyond? And quite honestly, since I mentioned that, there is there is a plan in the works that pending who's speaking to you. There is a plan in the works to tax unrealized capital gains. Think about that. Your portfolio, you buy in at, I mean, pick a number. You buy in at 10, and we'll use chump change, I guess you could say. So we'll say we buy a closed-end fund for $10. 4 years later, it's worth $20. You haven't sold it yet. It's worth $20 and it's just sitting inside your portfolio. Unrealized capital gains would mean there's a way for them to tax the value of your positive gains portfolio without you enacting an actual transaction. That's nuts. I mean, that's robbery. You cannot bring the top down. You can help the bottom up, but you cannot bring the top down. So let's see, back on track. So you see the big picture. We play the long game. Got to think for yourself. Got to have a strategy for the current market, sift the data, track the herd, invest where the herd is not. That's where you scoop amazing deals, and then you buy what the Fed cannot print. Then honestly, the last trick. So strategy wise, so it's see the big picture, play the long game, think for yourself, and now use the closed-end fund system. Our closed-end fund strategy sifts through all that data and takes favoritism out of the mix. I have favorite funds. I mean, there are funds that I just love, but if they don't fit the metric, then they don't fit the metric. So instead of playing favorites, we apply the system, we use our code, and we let it work. And the code is this: we follow the code unless there's a good reason to tweak it. It's much like what Barbosa says in Pirates of the Caribbean, and the code is more what you call guidelines than actual rules. But it's know your strategy, right? What are you what are you currently targeting and why? And then we're using that current market to optimize the long game. There are things, think of how to say this. So if the Fed cuts rates, bonds will go up. If the Fed cuts rates, stocks should go up. But the market in general is kind of volatile. How much is the Fed going to cut rates? Everything in theory should go up. I mean, everything in theory should go up. But the other sideline data, jobs reports, the inflation data, all that stuff still has an impact on the market, the new money. And say for my comfort level, there are some stocks that I want to pick up, but at the same time, it's just not the right time to buy them. Uh, I guess I'm kind of getting ahead of myself, ahead of my screener, but you want to look at the market for what you have right now to invest, but you also want to see the bigger picture, the longer game, right? So if rates drop and bonds go up in cycle, and rates continue to drop and bonds continue to go up, as bonds go up and make that next hump, and as rates make the next curve to go up, you have an option. You either A, sell high, right? So that you can then buy again low, or B, you ride the roller coaster knowing your stock value is going to plummet. And then you still get the crazy dividend, right? And then when shares are or bonds are low again, you scoop amazing value when bonds are low and unpopular, knowing that at some point they're going to ride the wave back up. So you have to play the current market because that's the game we're all playing. You have to play now and be able to predict or at least have a vague idea of where the market's going to go. Then we weed through the options, right? And we weed out what doesn't work and we weed out where the herd is. Like just because tech stocks are still interesting, the herd is pumping money into technology. They're pumping those values higher. That may or may not be a great place to invest long term, which if you invest there now, you're going to pay a lot more for it now than you would have a month ago. Three, we want to buy historic discounts, which means you got to do the homework or you watch my videos and let me do the work for you. Four, we focus on consistent and rising dividend payers. We bought several funds during the lockdown and that ramp back up when funds were just paying small dividends because they couldn't make ends meet, knowing that they would increase those dividends. That's been huge for us. And then you have to be mindful of the overall dividend yield. Our focus has been 9% plus, unless there's a good reason to buy something else. So on our targets list, has the strategy changed? Not really. I mean, no, not really. We're still looking at we're still prioritizing high fixed income bonds. And then after that, pending availability or maybe pending our funds, we're looking at general bonds, loans, and real estate. And then after that, it's still going to make the list, but it's not a priority right now. There's select tech funds and then stock funds. But honestly, it's just the market at large is that the Fed is pretty much saying we're going to cut rates. Who knows how much? But if we look at the economy at large, you still have a lot of people, me being one of them, but you still have a lot of people saying recession coming. And with a rate cut, stocks should go up in value. Everything should go up. But at a recession, stuff will drop. So it makes me hesitant to buy stocks. And that's not me listening to the herd because the herd itself is pumping new money into the market, just hoping the Fed controls everything and there is no recession. But change the lingo all they want, we're still headed to a recession. When you've got JP Morgan, I want to say their last probability rating was maybe 35% of having a recession next year. You've got several income strategy services predicting a recession on short notice. You've got Donald Trump predicting a recession or a possible recession next year. So it, it makes me hesitant to invest in stocks. Plus, on the stock end of things, you're going to pay more for it now than you did a week or two ago. So it makes me hesitate to invest there. So even saying that, let's look at where the bargains are for the week, and then we can finalize kind of an outcome or a direction of what we're going to buy on Monday. So this is the closed-end fund master. Purple, dark blue, green, and light blue get updated weekly. Everything else gets updated monthly, which means next weekend will be a full system update. And then I track funds based on targets, but it's this fund's data related to the historical data of this one fund. Um, so a triple asterisk is um, current discount is, well, here, I'll span over. You can read, you can pause and read the screen if you want. So a triple asterisk, you get a buy alert. So double the historical discount and then greater than the 5-year discount. 2-year would be, or a 2 asterisk would be a dollar cost average of what we already own. And then a 1 would be we're tracking it for any number of reasons. So we rank by discount. Now we rank by asterisk. And we come up with a short list of funds. We plop it into this spreadsheet. Let's see. Price per share is if we already own it. Current would be that we already own it. So if there was a question about money in regards to and yes, this is our portfolio. So HFRO 6.3275. That way I can look at what the current cost is versus what our average cost is per share based upon what's already in our portfolio. Or current, what we already own. Light blue is the individual fund. Dark blue is the Roth, and we're looking at the Roth. I forgot we added to that one. So first and foremost, we sort by policy or by when the dividend gets paid. And as much as I love KYN, it's currently about $2 more than when we bought it, and it pays quarterly. Love the dividend. Hopefully we'll continue to go up, but it doesn't meet the metric for now. So now everything pays monthly. So now we consider the yield. This one is tempting. Pricing seems stable. I think it'll go up with a rate cut. I mean, everything got to go up with a rate cut. I would love them to raise the dividend just a little bit because it would make people more confident on the price. But if we're going to prioritize 9%, I mean, we could pick for us. So yes, we could pick it up at discount and I mean, 38 cents off our average is a great deal. But if I'm going to prioritize high fixed income, as tempting as that is, it's not going to be what I pick in the long run, but it's good enough for me to keep on the list. So now we end up with 9% plus. Plus, honestly, HFRO remains the best deal, best overall discount. At 54% off, it's like paying 46 cents for every dollar you invest. And that's just a hard deal to pass up. I get why people are hesitant to buy it. I mean, they completely restructured their portfolio and cut the dividend back in January. I get it. But as more of their properties come online and as the interest rates drop, my hope, and honestly, my hope is that the dividend rises and the price stabilizes. But of what remains on the list. So if this is kind of my rationale. We own a lot of what River owns, we own in other places. So it's a no. But additionally, if I'm not going to pay this, then I'm certainly not going to pay for these two. The River's out. Utilities are up. Like we're late to the party. So unless you can snag utilities indirectly through a different fund, My option is to not, or I guess my advice would be to not go with a direct utility investment. And then this remains on the hit list, but it's all stocks and it fits into what I already said. So I mean it costs more than it did 2 to 3 weeks ago. Um, and it both with a rate cut should send everything higher, including bonds. But in a recession, for whatever reason, people pile more into bonds and not as much into stocks. And it just makes me hesitant just because, I mean, as much as the Fed's going to cut rates, the long-term status of the economy is just too unknown for me. Um, that's a great fund, but it's also higher than where we bought it. Most of these things are, to be honest, if we're going to, I guess, really compare. BRW 711, HGLB 710, SCO 610, CIF, oops, NBXG. I get you can make I mean, that's a dollar higher, right? You could make the argument that maybe it continues to rise and we're buying it cheap compared to what it could go. Yes, I get that. We don't own that. Then that one's already there. So of what we have, my strategy, I guess you could say, my individual strategy is I like to buy things in sets of 50 because I like the math. I mean, there were times where we bought less than 50, and it just feels like piecemealing things together more. That's why you see all these nice, even numbers. Um, so there is not anything on the list where we could just snag 50 and still meet that current fund availability, except for this one thing. And it's not just 50, we could pick up another 100 shares and 260-ish, right? Minus 180 would give you about $80 left. Monthly dividends are around 120, so that would be 200. So in theory, we could continue to just pick up small doses of this if we don't continue to sell more out of the individual account. Um, of the individual account, the stuff in blue, I expect will hold long term until the next wave rides or say the wave crest in that individual area. So you get MLP, overall energy fund, bond fund, and real estate versus healthcare without a manager. And it's on an automatic drip, which means like if we sold it now, when we got paid the dividend, we would still end up with partial shares that I would have to sell. So kind of stuck waiting till after the dividend. But at the same time, with lowering rates, the overall value should go up. Same thing for these two. Um, both cut their dividend ahead of the current high rate market. So with a lowering rate, I'm hopeful. And for that, I mean, we rode the roller coaster. Um, and I mean, the roller coaster is fun on the way up, but I will tell you the roller coaster sucks on the way down. So we got great dividends. Um, but that being said, um, I'd rather not ride the downward roller coaster. So if we get the upswing of these where I would like in the sell points or close to it, same thing for this one. If we hit our sell points, then yes, I think we sell and then we move on. But the others, I mean, it says lifetime, but quite honestly, if we hit the next curve in the oil market or just the energy transfer market overall, I mean, everything comes in cycles. If we hit the next cycle, I'd much rather, sell this high and then buy it low again. Rothwise, everything inside the account, it's not tax deferred. It's just not taxed. So we would pay a capital gains tax in this one. And in that one, so long as it stays in the fund and we jump through the hoops, we do not pay taxes. And that sounds much more appealing. So where does that leave us for the week? Um, I could argue for all of these funds. I really could. Mixed bonds, you get closed-end funds, and it's an activist, it's a shareholder focused account. I like that. You get bonds and it's a backdoor play into energy and utilities. I like that. Um, on the pendulum of, we'll say, loaded with assets, and on the opposite end of, I mean, they still have a ton of assets, just not as much. FCO is just continuing to swing higher. 3 months ago, they had 2 billion in assets. Now it's 2.3. I expect it to keep going. On the opposite end of that is CIF. So you end up with 2.3 billion compared to like 33 million. Uh, but they both specialize in corporate bonds and high fixed income. Um, it, my strategy for both would be, FCO would be like a fund I'd hang on to. CIF, their history, much like GLO and CTR, comes in waves. So that they crest and they fall. And I strategy wise, it would be we've bought CIF waiting for that uptick in wave, and it has. It's gone up, but in a lower rate market, I expect it to go a lot higher. So we're playing that strategy. We're riding the roller coaster up, hoping it gets to a certain point before we sell it, taking those proceeds and then pushing them into other investments. Um, I could argue for this. Like if you're not into tech, you're not in stocks yet, and you want a technology fund, I like this fund. This is a technology fund. It's not structured that way based on how most people would look at it, but all of those companies need technology in order to work. But it's the same thing. It's stocks, and it's not bonds or real estate or loans. And for me, it's just not where I feel comfortable right now. This, I, this is tempting. I mean, it really is, to get a steep discount on what we already own, uh, with a price that's stabilized. It was swinging pretty widely, with a discount that really has stayed the same. It's been hitting about 54% for a while. Didn't make that list for whatever reason, or that one. It's been 54% for a while, but if I'm going to prioritize high high fixed income, then it's not going to make the cut. Plus, of what we have, we might be able to pick up 40 shares, but we certainly cannot pick up 50 shares. So to prioritize high fixed income and keep my strategy of buying things in sets of 50 and buying something in greed, in that greed cycle that's still on discount and meets our metric, and buying something, you can't say knowing because the stock market is ever changing, but buying something for a great deal at a great price before what we all hope the Fed does, lower rates, sending bonds higher. That's it's the best strategy for what we have, but it's also just the best strategy for the current market. Now, if we had more, would something change? Would we buy different? I don't think so. Uh, we would buy its counterpart on that pendulum. Instead of buying just one end of the pendulum, we would buy the other, and or buy them both together. Uh, and then pending remainder, either look at BRW and HFRO, just because it is just a crazy discount. Um, but for right now, it's still the best strategy remains to pick high fixed income corporate bonds, part knowing, part hoping the Fed will lower rates, which would send bond prices higher. And when the majority of new money is pumping into stocks and pumping into technology, there's been some change in bond land. I mean, just based on these prices, right? That's higher. That's got a mixed bond portfolio. Those are both higher. Uh, Knowing there's been a little bit more money into the bond world, everybody always comes late to the bond party. So if the Fed cuts rates and bonds go higher, people will come late and then push that price ever higher. So that's what I got. If we're buying Monday, and we are, we're buying this. And I'll buy it at opening bell or as close to opening bell as I can get it and enter it into the system, meaning I'll add another line in and change the dividend payout calendar of the charted and like the expected and the actual. I'll update things. And then, quite honestly, I will set it and forget it and then come back and reevaluate it at the end of the week. So that's honestly all I got. Otherwise, I will continue talking in circles. Uh, so that is my top pick for the week. I mean, CIF for our budget, CIF. Pending your budget, well, it's your budget and you get to figure out how to spend it. If you like the content, consider subscribing to my channel. Hit the like button. It really does push videos out. And wherever your destination lies, I mean, wherever you want to go, it's not going to happen on its own. Like that boat will not pilot itself. I mean, for all, I mean, you could have your anchor on, right? You could have your anchor down and just be skimming the top of sand, and that wind will push you even though you're anchored, right? But if you want to go somewhere, really go somewhere and not just be buffeted this way and that by the winds, then you got to have a plan. You got to have a strategy. You got to know some particulars. And if you want to know any of that, if you want to know more about that, then come find me on Facebook at the Navigate Your Finances page. And I get into everything, the backstory, how you make a map, how you follow that map, going from a full-time job into something different, and then really investing your money forward. So regardless of where you're going, regardless of what you want to do, got to have a destination in mind. And you can't just hope it happens. You have to make it happen. So I wish you a great week. I hope you have a great short week. I hope you had today off. But I wish you a great week, and I will see y'all on another video. Bye-bye.